Hello sector watchers, welcome to the show. This is the 128th episode of Sector Spotlight for Tuesday the 24th of May, recording it on Monday the 23rd. My name is Julius Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. My contact details are on the screen in case you would like to get in touch. What are we going to do? Well, before we go into that, I need to, you know that sometimes I share some interesting events that are happening either in the Netherlands or in my life. And I guess, well, maybe not all of you, but a lot of people know that a couple of years ago we moved out of the center of Amsterdam from a very small house, as I said, in the center of Amsterdam, to a pretty big farmhouse just outside the city, about an hour outside the city. And it is an old horse boarding stable. And lo and behold, after 3 years, we now have, or we had, 6 horses, 4 big ones and 2 Shetland ponies. But last Friday, our mare, Furia, gave birth to a filly named, so we named her Sweet Liberty, and it's absolutely fun and exciting to see how that little filly is getting along and how nature is taking its course and how they're taking care of each other, or how the mother is taking care of the little filly and trying to figure everything out. It's a little miracle. I mean, within an hour, they start. So the birthing process is like 20 minutes. That's super quick. I didn't know that. And then within an hour, the little filly stands up, knows how to drink with the mother, and walks. And you know, within a couple of days, it's like that's just a little horse walking around. It's absolutely amazing. Anyway, you can see a few images and pictures, and oh yeah, the reason that I playing that movie is because she knows exactly what RRG is all about. She's running around in circles, and I thought that was pretty applicable. Anyway, let's get started. So for this week, I want to talk about the asset classes. We didn't do that much last week, so we're gonna dive into the asset class rotation. We're going to take a look at sectors, of course, and then if there's any time left, and I assume I'm going to make it work that there is any time left, we are going to look at some international rotations and see how the US fits into that image and what's happening in the world right now. That's the plan for today, ladies and gentlemen. This is Sector Spotlight. Well, the rotations for asset classes. We have the daily RRG on the right-hand side and the weekly on the left-hand side. And we start on the left-hand side with the weekly, because what you see there is that both commodity ETFs, DJP and GSG, are still way to the right. They're losing relative momentum, but they are by far the strongest asset class. That has not changed. And you can see that on the daily, GSG and DJP are going through a corrective move that is in line with what we see on the weekly. But I think that they are still a very strong, if not the strongest asset class in this universe. So I'm gonna disable the tails on this one here, because otherwise it'll be distorting our image. And now we got a little bit more clarity, because now that the commodity ETFs are gone, you can see 2 others. You can see V&Q, the real estate fund, real estate asset class, and the US dollar index way up inside the leading quadrant. And especially the US dollar tail remains very strong. We've been talking about the dollar strength here for quite some time. And I think that's still going on. You see that the tail is rolling over a little bit here, and if we look on the daily RRG, then you can see that it is moving from leading into the weakening quadrant. Given the high level of RS ratio both on the weekly as well as on the daily. I am still going to follow the track, the tail, that this is a setback within a longer term uptrend. If you look at the dollar index, if you look at the dollar versus other currencies, so let's say euro dollar, then it's going down. So it's a downtrend and then you see a hiccup. We'll look at the chart in a minute. Real estate, I think, is now really rolling over on a weekly scale. If you look on the daily, then you can see a relatively strong recovery, but it is way on the left-hand side of the chart. So this is also should be judged as a recovery within a weaker picture, and that weaker picture is developing on the weekly chart here. Now, more importantly, the relationship between stocks and bonds, because there's something going on there. So again, I'm going to zoom in here. So I'm going to disable V and Q and the dollar index. We know where they are. Fit it, and now we can get a good picture here of what's going on. And we have corporate bonds, government bonds, high yield, and we have stocks, SPY. And if we look at the daily, then we have SPY inside lagging, and we have corporates, governments, and high yields on this side. Now the big picture here, I think, is getting more and more clear that fixed income is coming back. We had the discussion, we discussed a few times before here on Sector Spotlight, that the risk was coming from the bond markets. And we've seen the big declines in GOVT and IEF. We'll look at those charts in a second. And because those fixed income indexes came down so fast, that was the reason why stocks, SPY, was still to be preferred, because these bonds were simply dropping faster than stocks. So even despite the decline in price, that meant that stocks were still the preferred asset class. I think it's changing now. It's very early, but if you look on the daily, then you already see it. You see SPY inside lagging. You see those at least corporates and governments moving at a nice tail further into the leading quadrant, and high yield is going through a little corrective move, but the last 3 days, it has already started to curl back up. And when we put that into a longer term perspective here on the weekly chart, then you can see that corporate bonds are deep inside lagging, but they are picking up. High yield is very clearly inside the leading quadrant, and you see that government bonds, if we zoom in on that one, came from leading, and they are now almost vertically coming back towards the leading quadrant, while SPY, stocks, has made a very unusual hook back to the left. And you all know that when you look at this on a shorter term time frame, that you will see at least some form of a rotational pattern. But here also on the daily, you can see that it is going very rapidly. If we zoom in on this rotation here, that happened last week, then you can see that even here, this rotation is a very rapid rotation back down. So I'm recording this on Monday after the close, so today was a pretty good day, but you can see that the trends, well, it was a pretty good day in price terms, but if you look at the trends, and especially at the relative trends, then you can still see that stocks are weaker than the cluster of fixed income, and definitely weaker than both commodity index. So caution still applies to the stock market as far as I'm concerned. Let's move to a few individual charts. We already discussed GOVT. You can see that GOVT, after that massive decline, is now coming to rest in an area where it formed a very important support level at the end of 2018. So I think that's a very important level. I think it's going to hold for a while. And you can see that the fact that because it is now stalling, that relative strength is now rapidly accelerating, and it looks as if it's going to take out some overhead resistance and start pushing GOVT into the leading quadrant on the RRG. Quite similar picture for IEF, which reached the target based on the head and shoulders pattern. Not quite reaching the lows of 2018, but you can see that there is a big cluster here in basically the whole year of 2018, where we are now in that range. And here also you see that turnaround in relative strength. If we go to the stock market, that's what we're looking at. Here is the chart of SPY. This is the weekly chart, and I think that it's pretty clear that we've broken that uptrend. We have lower lows and we've got lower highs. Very recently we broke below the previous low, which confirms that that rhythm of lower highs and lower lows is still intact. There is no divergence whatsoever in the RSI nor the MACD, and I think that the old support level, that's rounded off around 410, is now going to be a very important resistance level. We're currently around 396, let's say 397. So there's a little bit of upside, but not very much. As a matter of fact, theoretically, this downtrend of lower highs and lower lows will remain intact as long as the new high on a weekly scale is going to be formed, let's say below 460. Of course, the lower the better, but it will take a lot of power for the market to turn this downtrend around and, well, not even around, but also to stop this downtrend. That doesn't even mean it's going to go in an uptrend, but to stop this downtrend. So based on this constellation, this structure, I think you still have to be very, very careful with the stock market. If we look at the daily chart, we zoom in a little bit more. You can see how this move here is a very nice series of lower highs and lower lows on the daily scale. But what we see here, and that's important, is that there is some positive divergence building up between the RSI and price. Now you all know that positive divergence usually means a pause or a reversal of the previous trend. Given the long-term picture, given that weekly chart, given that resistance area, and here it's pretty clearly visible between 410 and let's say 415, that's the upside. I think that's the upside that you will see. That's the pause, that's the potential that is coming off that positive divergence. The market is currently digesting this decline, and it's doing that with a little bit of positive divergence. However, the upside is limited, I think, towards 410, 415, while the downside is pretty seizable. So from a trading and an investing perspective, I think that the upside potential is relatively small, while the downside risk is relatively big. Not very good odds for long positions. Of course, you can trade around it, etc., etc. But my big picture view is that market is currently resting at support, showing a little bit of positive divergence, makes it possible for a little bit of a rally, but it's not going to turn that longer term downtrend around anytime soon. Here is the corporate bond chart, and the interesting thing is if you make this longer, then you can see how important that level is where we currently are. This is the 2018 low, and I think if I make this a monthly chart, then you can see how important that level has been in the past. You can see here 2003-04 we clustered in this area. We did it again here in 2010, and then since then it's been a support level. By the way, be careful, this is the unadjusted price series. And I'm doing that because the unadjusted price series, they show you the levels that are in the heads of the investors. So apparently that area around 110, 111 is a very important support level according to, call it the psychology of the investors. If we do the same for high yield, then you can see that we are here also reaching lows that have been a while since we traded in that area. Let me make this a little bit longer as well. See where we get there, and you can see that we're resting at an area, around an area that was an important support level around 2016. Let's make this a monthly. And you can see that we had a high here. This is 2008. You gotta be looking at rough. It's not very precise, but the big picture is what I'm trying to show you here, where we are currently coming into a region where major support levels have formed in the past. And that could turn that relative strength line around and push high yield further into the leading quadrant. Finally, the US dollar, we already talked about it. You can see that it is touching on an important resistance level, and that translates into euro dollar pushing, let me do it like this. So here was the 106, we broke it. This is the weekly chart. We're now getting back into that channel. I think if you look at it here, 108 is the resistance level to watch. And you can see that back here on that daily chart where we've sort of rounded that small bottom, and then you can see that around 107, 108, new massive resistance is coming into play. I'm going to leave it at this for the asset classes, and we're going to switch to sectors. Taking a quick look at the rotation of sectors, I think we need to conclude that defense remains in the lead. If you look on the daily RRG here on the right, we have staples, we have utilities moving over there. Sorry, this is healthcare, the tail here, healthcare and utilities moving. Utilities rolling over, but they're still inside the leading quadrant. Energy remains very strong, obviously. Staples was the sector that was surprisingly weak last week. It got a big smash on the head last week, and that pushing it now further into the weakening quadrant. Nevertheless, it remains a very defensive sector. It remains on the right-hand side. We're going to have to wait and see how this rotates here. On the weekly chart, XLP is still well within the boundaries of the leading quadrant and moving at a strong heading. And if we stay with the defensive sectors on the tails, we have healthcare here coming down slightly, but still moving to the right. And we have utilities coming down and now starting to move to the right again. And energy obviously stays far on the right. Let me take off energy here to blow up that chart a little better. What else can we see? We have real estate picking up here, but rolling over. It's similar as what we saw with V and Q in the asset classes. And I think that the offensive stuff, the growth stuff like discretionary tech remains inside the lagging quadrant. That's an important message. Financials picking up, but still inside the lagging quadrant. And if we bring that to the daily, then we see that discretionary here is now really, really weak. We see that tech is rotating back. This is a very clear example of how that hiccup here created that tail getting shorter, but still remaining inside the lagging quadrant. We had that improvement that caused that, and now it's starting to pick up the pace again to the downside and moving into the lagging quadrant. So be careful with tech and discretionary still for the time being. Here is financials now also rolling over. Tried it a little bit, rolled over. It's a very short tail, as you can see, very close to the benchmark. It's now about to roll over back into the lagging quadrant, and I wouldn't be surprised if we would see the tail on XLF moving further to the left, lower on the RS ratio scale, meaning that the sector is becoming relatively weaker. Now, one sector that stands out to me that I've been monitoring this for a while, and that's the materials sector. If you look at this, this is one of these sectors that are not making very big moves, but it's very stable. Look at that tail. It's just every week, boom, 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 continues to move into that leading quadrant. It is at a very stable relative uptrend. And you can see that also here on the daily, where you see that the tail for materials is a very short tail, and it's continuing to roll on the right hand side of the graph. You see that we're now already back in the start of April. How that tail continues to rotate around that 100 level on the momentum scale, and then just gradually moves up to the right. This is an extremely good example of a very strong relative uptrend that is pictured by a very nice stable tail on the weekly chart, and that like a corkscrew rotating to the right on the daily. Anyway, I thought that was interesting to highlight here because you don't see that very often. It's a very stable trend. And if we bring that to a daily chart, and then you see what I mean. Here you see that very stable trend in price, and here is that moving higher, and now we're even peaking above early 21 highs in terms of relative strength. So I believe that this is still a very stable sector, even still in price. This is not a downtrend, and obviously the relative strength image is very, very clearly very, very strong. If we quickly go through them, we communicated about communication services. We talked about communication services last week. That image didn't change yet. It's still bouncing. It looks there is a little bit of upside inside that channel. Then the next sector is financials, and it's inside the lagging quadrant, but if you look on the price chart in combination with the relative, you can see that especially the price chart is looking very, very weak. Very limited upside potential, and there is some support in the 30 to 31 area. If that support and relative strength breaks, then there will be even more trouble for the financial sector. Quite similar picture for industrials, rolling over, clearly completed that or came out of that trading range on the price chart and is now inside a range on relative. Again, if that support in relative breaks, then we got an acceleration lower there. Technology, clearly in a downtrend, both in price as well as relative. That didn't change. We can have a little bit of support here, but the overall picture, lower highs, lower lows. We talked about staples. That was a weak week for staples. We dropped out of that trend channel. We're resting at support right now. From a relative perspective, sector remains one of the better sectors from its defensive character. Same goes for utilities. Out of the doldrums, above that resistance area is now acting as support, and clearly that relative trend is still moving higher. It'll go with ups and downs, but the overall picture for utilities is still a strong sector. And then healthcare, especially from a relative perspective, that goes really, really well. And it managed to kind of hold up above support, above that rising support line and that horizontal support level just below 125. And then I think the weakest sector in the universe right now is consumer discretionary. That is already a series of lower highs and lower lows. Look at that sharp decline, taking out support, taking out another level of support. First stop now 130 with limited upside potential. And if you look at the relative, then it becomes really, really weak, and we're hitting the lowest levels that we've seen since 2018 and maybe even earlier. Okay, now I have about 2 minutes left to quickly talk you through the international position of the US market versus the rest of the world. On the left-hand side, you see the RRG that shows a bunch of major stock market indexes against the Dow Jones Global. That's the benchmark. You can pull this down on the RRG page. For this one, I have added the NASDAQ and the Dow Jones Industrials because what I noticed is that if you look at this chart, and I think a few weeks ago I played around with this chart using $1 to highlight the uptrends and the price trends in these markets. And we talked about that more extensively last week in Sector Spotlight. If we go back to the image of international stock market indexes against the Dow Jones Global, then what you see is that the North American markets are all at a negative heading. So it starts with the NASDAQ here inside lagging. Then you got the S&P that's moving into weakening. You see that the Dow Jones Industrials at a very short tail is rolling over. You see Canada, you see Mexico, and you see Brazil moving from leading into weakening. These are not the worst, but if you look at the US, that threesome of US, NASDAQ, SPY, and Dow, while the rest is moving to the opposite side. And the only conclusion can be is that the US, the weakness of the US, because the US is a big chunk of the Dow Jones Global Index, is actually dragging down the rest of the world, and that by default pushes a bunch of these other markets into the top right leading quadrant. And quickly looking at the charts for, I think the Nikkei is very interesting to look at, the Japanese market. If you look at where it's resting right now, about on a major support level, and look at that relative strength versus the Dow Jones Global, that's doing really, really well. And also the Hang Seng in Hong Kong. If you look at the chart, this is the weekly chart, you can see how this relative strength is rolling up and trying to turn around, and how this is resting at a support level dating back to 2016. But it gets even stronger when you look back longer on a monthly chart, and you can see how important that, let's say, 17.5 to 18,000 level is. So please bear in mind there's a few other options outside the US. US is currently dragging the world stock markets down. And that wraps up Sector Spotlight for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you again next week, same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.